Bring in Josh Brown of Ritholtz Wealth Management to talk more about it. He's also, of course, the CNBC contributor. So, Josh, I tell you, bear markets aren't easy, even for bears, as they say. We're up 15%. If you, for the last few months, have been saying, look, the economy's decelerating, the Fed's still tightening aggressively, we still don't know exactly what the effect on earnings are going to be. Who knows? Maybe crypto's going to blow up. There's been no net downside in the S&P for 6 months. So, how do you read that? Is that a selling opportunity or just the way it goes?
Well, I think the new lows are still occurring, but they're occurring mostly in stocks that are not even in the indices. So they're occurring in the growth stocks that were never profitable. A lot of those stocks this summer were down 50%. The market has been able to recover, but those stocks are now down 70 and 80%. A really good poster child for what I'm talking about is SoFi. This is a company where the momentum has been horrible the entire time, regardless of market bounces. They're getting absolutely no relief from the headlines. Now we have to worry about them in terms of crypto. Then we hear about a student loan repayment moratorium. It's like one thing after another after another. There are a lot of stocks like that. On a day like today, though, they're getting these bounces, and I think that's because of what you were talking about. The idea that the Fed is way closer to being done than maybe we thought 2 or 3 weeks ago. And the data would give them that cover. So it's what I call an inside-out day. You have the hardest hit stocks up the most. I see DocuSign bubbling up, for example. And then what's taking a break? Staples are flat to down, and energy is pretty much all red. So that is all counter-trend stuff. And I don't know that that's the bet that you want to make going forward, even if this could last for another week or two.
Right, that is true. Now, if your choices were, bombed out, high growth, low profitability story stocks that have been killed, or super defensive, maybe you have to pay up for the stability of staples and healthcare, it's tough to know. But you also have, as we were just hearing, Deere and Cat pretty much making new highs, pockets of industrials doing well, financials are actually outperforming over the last little while as well. And so you could either say there's a macro message there, or you could just say the market is trying to latch on to, where there's a little bit of low expectation and some decent earnings trends.
Yeah, listen, there are subsectors and industry groups that are at all-time highs. We were talking about the insurance stocks for the last couple of weeks. And yesterday, across the board, they all made new highs, all the big ones. Healthcare fits into that basket where you don't really have to worry quite as much about what the Fed might do because a lot of the growth stories in healthcare are secular. And they have pricing power, and these stocks are working. So I don't think that everyone has to play the same game of, is the Fed doing 50 or 75? And quite frankly, if there's a stock that you would buy right now because the Fed's about to raise the overnight rate 50 basis points, but you would not buy it if they raise by 75, what is that stock? And who trained you? Like, where did you learn how to invest, right? So I think that game has gotten played out. And now we're really more focused on the broader earnings picture. But we're seeing demand slacken. Look at the PMI numbers, manufacturing and service continuing to contract. Things are getting tougher and tougher. Housing market still looks terrible. These are really important indicators, I think, telling us that 2023, even if the stock market's going to be better next year than this year, will continue to be a challenge.
No, that's absolutely the thing to focus on right now, because we can get comfort, perhaps, that the Fed is slowing down. We got the destination that they're heading for roughly in sight. We're months away, let's say, before they pause. But a Fed pause or even a Fed pivot to easing, it's only a bullish trigger if the underlying economy is not falling apart underneath it, right? I mean, because the Fed's usually cutting in the early part of the downturn, right? And so that's the tricky part right now, is figuring out what lagged effects are yet to come, and what it means for earnings in 2023.
Michael, to me, that what you just said is the number one question right now. I put this on my Mastodon account this morning. Yes, I am a member of FinTusk. And what I basically did was I took a chart from the Journal that showed the start of the rate hike versus the start of the historical bear market. And this is a really weird one. If you look at the top for the S&P this year, it happened the first day of the year in January. We didn't get the first rate hike until March. So we were already heading into a bear market before that rate hike. Historically, you have the rate hike cycle, and you have like months or even in some cases years before the market tops out and we head into bear market territory. And that's going back to 1980. This is really the first time. So what do you do with that information? Maybe you try to be optimistic and say, for once, the stock market started to sniff out both the rate hike cycle's beginning and end, and maybe we've done a lot of the work in advance, getting rid of some of that excess and getting down to a more reasonable valuation. That's like maybe the silver lining that we can take away from this.